You can start when I start. How's that?
I just did.
Oh, you did.
So you better start.
Welcome, everyone. Thank you to everyone for joining us today. I'm Catherine Wygant Fawcett. I'm the Executive Director of the Institute for Family-Owned Business, otherwise known as IFOB. Welcome to our remote users. We do have some people coming in from Central Maine, so that's exciting. We will be recording this program and may post it on YouTube for webinar a later date. The IFOB is a nonprofit that helps family businesses succeed. We have over 40 programs this year, and all members and future members are welcome. Well, we have some future members here, so that's exciting. Please take a look at our calendars out front. This is for the second half of this year, and we have our website at fambusiness.org. Our membership runs on the calendar year, so they're more than half off now. So if you want to get involved, that's great. And everyone in your company is considered a member. They can join in our programs, and your information will be listed on the website about your company. Our board has instituted a code of conduct, and they ask that I read it each time we have a program. The Institute for Family-Owned Business is a nonprofit organization dedicated to the success of family-owned businesses in the state of Maine. Our purpose is to provide opportunities for family-owned businesses to gain knowledge and expertise concerning the challenges specific to family businesses. Shared expertise comes from IFOB resources, invited experts, sponsors, associate partners, and the family business members themselves. Through the IFOB, relationships will develop that are valuable to all concerned. To foster an environment necessary for trust and sharing, proceedings of the IFOB should not be used for professional advantage. We expect confidentiality in all matters discussed and shared in our programs. Solicitation of business at events or programs is inconsistent with the overall mission of the IFOB. Thank you for respecting this code of conduct. So today, we have our second in a three-part series on the art of family business, and I have postcards out there. So we have action, reaction, and traction. And our program today is about reaction. How do you manage taxes? And Frank O'Shea from BerryDunn will be leading off the program, along with Andrew Smith from Newman Noyes and William Becker from Key Private Bank. I'd like to thank our sponsors today, Alban, Randall, and Bennett, BerryDunn, Newman Noyes, Key Private Bank, Huston University, and Maine Biz. In a few minutes, I'd like to invite Dan Dorian from Alban, Randall, and Bennett, who is sponsoring the whole series for us, to say a few words, and then we'll turn it over to Frank O'Shea, who's also our board treasurer, so he keeps us on track. So we value your feedback, and at the end of the program, I'll be handing out a survey, and here it is. Please give us your thoughts. This is how we came up with this program this year, because everybody was saying taxes, taxes, taxes. So I'm excited we have a full room here to talk about taxes. And then I'll come around and we'll get your business cards, because we have some fabulous door prizes for you. So I will turn it over to Dan, and then we'll have Frank come up. Thank you.
Thank you. Good morning, everybody. Welcome to session 2, best practices to avoid taxes now and in the future. And thank you to the panel for participating today. My name, as Catherine mentioned, is Dan Dorian. I'm a principal with Alban, Randall, and Bennett, CPAs here in Portland, and we're the event sponsor for this series. I've been with ARB since I was an intern back in college in 1986, back when the Tax Reform Act of 1986 came into being. And I've seen a lot of change, as I'm sure my professional colleagues have seen a lot of change over the years in policy, and rates, and laws. Minimizing taxes is something that's always in the forefront of being an interest to business owners and individuals. But it's rarely the client who says to me, I really think I ought to pay more. But believe it or not, I have had a client say that to me, which is interesting. A little bit about ARB. We have about 45 employees. We do the usual tax and accounting stuff that CPA firms are known for. We like to think we do it with great service. We advise a number of family-owned businesses. We've been fortunate to have many clients who have been associated with us for a number of years. I've been able to witness firsthand the evolution of a family-owned business from startup to maturity, sales to third parties, preservation of the business or the resulting assets and investment entities via family offices, investment vehicles, trusts, and then maybe charitable goals being achieved with a private foundation. The first session of this series was about kicking off your succession plan. David Jean, my colleague, participated in that session. He's a certified exit planning advisor, and we have this entity called Altus Exit Strategies that David leads to help business owners navigate succession planning issues. It's easy to put that off because it's not easy to do. And Altus is there to try to help people facilitate that. I encourage you to learn more about ARB and Altus by looking at our website, arbcpa.com. I'd like you to mark your calendar for the 25th of October, which will be the third and final part of the series. Free federal and state resources for family-owned businesses and an IFOB Associate Partner Showcase. That's going to be out at Ocean View in Falmouth. So on behalf of all of us at Alvin, Randall, and Bennett, thank you to the Institute for Family-Owned Business for putting on the program, all of you for attending. Hope you enjoy the program. And now I'd like to turn over to Frank O'Shea to get things started. Thank you.
Thanks, Dan. Can everybody hear me all right? Thanks for coming. As one of my partners said, it's August in Maine. We're going to talk about taxes, and I'm surprised we got a good crew to come and listen. So thanks for coming. The whole objective today, I think, is to provide some thoughts and ideas for you individually and for your businesses, in order to save taxes. The whole idea is to pay less tax, keep more of what you earn for your family and for yourselves. So to that end, we've put together an outline that we're going to sort of follow, but because we're financial people, we need to be organized, so we have a nice outline. But it's an open forum here, and as we go along, if you have questions, we'd like to hear them. Just show of hands would be great. If you want to jot down a question, there are pads of paper on the table, and if you're thinking while we're speaking of writing a question down, just fold it up, and Catherine would be happy to pick them up, and we can cover those at the tail end of the program. So the outline today, basically, we're going to spend some time talking about just sort of basic tenets of tax planning. What are the basics? Some concepts and some planning guides. We're going to talk about the tax rates, and talk a little bit about where the Congress and the President are headed, or at least what their thinking is as it relates to changes that we may or may not see, but hopefully in the next year or two we will see some changes, and we should be at least thinking of those as we plan for taxes in the future. Andy's going to then cover some business strategies. We're going to talk about taxes in the context of a business, and then we're going to talk a little bit about captive insurance companies. Bill's going to talk about captives. It's a great risk management tool, and it has its own IRS code section, which has some nice tax benefits associated with it as well. And it's not, I don't know that it's very well known, but it's a nice planning tool both for business and for tax savings. So again, we encourage your questions and write them down if you feel like you'd rather be anonymous. So just show of hands, how many are familiar with S corporations? Businesses operate in S corporation form. LLCs, pass-through taxation. Okay, because as we talk through this, a lot of the tax issues that we're going to be facing are at the individual level, right? The business adds to the personal return, and that's where you pay taxes. So that's going to be important. And I guess, unless we, just to protect ourselves, any IRS agents in the room? No. Okay, having seen none. Good. So fundamentally, when we as tax professionals talk about taxes, we're thinking in terms of really two main concepts: tax avoidance, right? Not paying the tax or earning income that's not subject to tax. And tax deferral. Tax deferral being, we're going to pay tax, but we're going to pay it later. Okay, so time value of money from a standpoint of a financial concept, right? There is a third concept called tax evasion. We're not going to cover that. It's a very risky proposition, and the penalties are very severe, so we're not going to talk about that at all. On tax avoidance, so what does that mean? Well, think about state taxes, for example, right? Florida residents don't pay state tax. That's tax avoidance. In Florida, New Hampshire, Nevada, places where you might live where you don't pay tax. That's a tax avoidance concept. Bond interest, municipal bond interest. There's no tax on that. So you see a lot of investment decisions being made around, well, I'm in this tax bracket. If I can get a 3.5% yield on a municipal bond, that's the equivalent of a 5% taxable yield. That might be a better investment. So, tax avoidance, investing in getting income from tax-free sources. Life insurance, another example of tax-free proceeds, if you will. And it's used very often in a context of business succession and in estate planning as well. And I should say, we're going to be talking primarily about income taxes today, but you can't really do it in a vacuum without considering estate taxes as we talk about businesses and ownership succession. Life insurance, I've had a client in the past, for example, was so tax averse that he had a business and some other assets that accumulated the value of about $6 million. And this was a time when the estate tax exclusion was $1 million. So he had a taxable estate. So he formed a life insurance trust, bought $6 million worth of life insurance, and left his business and other assets to charity. So the result of that was his only son, got $6 million from the life insurance trust. The charity got $6 million worth of value, and the IRS got a big goose egg. So that was an extreme plan, but tax avoidance, right? Using life insurance and using it well. There's some other things that are not quite so, so much of a tax savings, but they're tax avoidance. Roth IRAs, for example. Okay, so things like Roths, health savings accounts, HSAs. Right, you get a tax deduction when you put the money in. When you take the money out, as long as it's used for medical reasons, there's no tax. The Roth IRAs, there's no tax on the accumulation of the earnings. You have to put after-tax money into them, but it's still tax avoidance. And then in the context of transitions, you may have heard an awful lot about it here in Maine, the concept of an employee stock ownership plan, right? Well, ESOPs, if they own stock in S corporations, the earnings that are attributable to that ownership are not subject to tax. Very, very huge tax savings there. It's a very big tax savings. And it's, quite frankly, probably one of the factors that has probably pushed people over the edge in terms of making that decision is the future tax savings. On the tax deferral side, right? Tax deferral, we're going to pay the tax later. Can we defer it? Well, things like retirement plans, right? Your 401k plan. You can reduce your income now. You pay the tax later when you take the money out of the plan. But in the interim, you get tax deferred compounding, right? So all the earnings are going to be tax deferred. And when you withdraw those funds, that's when you pay the tax. In the context of sales of assets, if you do an installment sale, which is not unusual, again, in a family business context, you pay the tax as you receive the payments. So you can defer the tax along with the cash flow in a sale transaction. So again, that's a tax deferral strategy. And I guess to another extent, real estate investments. We have a lot of clients who arrange their affairs with real estate entities. The depreciation benefits that you get against the rental income is a tax deferral strategy. Ultimately, the depreciation reduces the value of that asset, and when you sell it, you're going to pay the tax. But in the meantime, the depreciation will shelter some of that income and defer the taxes on that. Just overall, in terms of planning for taxes, I was looking at some of the materials, and there's a famous quote from a Second Circuit judge that goes back to 1934, and it's used an awful lot in court cases when you see the write-up. It's a great name. His name was Judge Learned Hand. That was his name. He says, quote, "Anyone may arrange his affairs so that his taxes shall be as low as possible. He's not bound to choose that pattern which best pays the treasury. There is not even a patriotic duty to increase one's taxes." That was 1934, and I've seen it quoted in a lot of court opinions since then. And an early mentor of mine once told me, and I remember this, he said, the IRS and Congress controls the law, but we control the facts. So we can arrange our affairs to pay the least amount of taxes. So again, that's something that we always think about when we're working with clients. So sort of an introduction. Now, in terms of tax brackets, I want to go through just some basics, just so people get a feel, and we can refer back to this as we go through the conversation today. Can you put up that slide, the second or third slide, I think it is? Yeah.
And you?
I do, yeah. I have it right here. So, paying taxes, right? It's a pretty simple formula, although not very many people really truly understand it. You add up your income, right? Your wages, your pass-through income, your interest, your dividends, your Social Security if it's taxable, your IRA withdrawals, whatever it is. Add up your income. You get a deduction. It's either an itemized deduction, where you get mortgage interest, things like real estate taxes, state income taxes, contribution deductions, or there's a standard deduction. And the standard deduction, if that's higher, you can take that instead. Then you come up with taxable income. And then you figure out what your income tax is using a lot of rules that most people don't understand. And then you come up with a number. Then there's an alternative minimum tax, which is another way of computing your tax, which nobody understands. And if it comes up higher, you pay that. So that's our current system. That's what we deal with right now. So in terms of the tax rates, what you see in the chart, we've put together the current rates for married, joint, and single individuals, and we've compared it to the proposal, or one of the proposals that's been put forth. This is the latest one that's been put forth by the president in terms of reducing 7 tax brackets to 3 tax brackets. All right, and you see the 7 tax brackets. The top line is the married filing joint, and the breakpoints there are, up to 19,000, you pay 10%, and then up to 76,000, between those two, you pay 15%, and so forth, all the way up until you get to about $470,000 of taxable income, and then you're in this 39.6% tax bracket. Okay, so you don't pay 39.6 on every dollar. You have to get to $471,000 of taxable income first. So if you're in the middle of this spectrum, you're paying that percentage on each chunk of the income in those brackets. Okay, and where the government is coming from, and Congress and Trump are close. The Congress didn't want to go quite as deep, I don't think, but when you look at the 3 tax brackets, we're looking at the latest proposal, and these are not cast in stone right now, but this is sort of an indication of where the administration is headed. They're looking at 2 things: one, tax reduction, but also simplification. If you can get to 3 tax brackets, it makes things a lot easier. And so the breakpoints there are 75,000 and 225,000. So the 10% on the first 75,000, 25% on the next 150,000 up to 225, and then 35% over that. That rate has changed a couple of times since April, but again, it's indicative of where the government is headed and where the proposals are headed. And you can see on the bottom is a similar chart with respect to individuals. So the other thing that the proposals are considering is the standard deduction. Okay, right now, as I said, you get either itemized or a standard deduction. Right now, the proposals have been to double the standard deduction. So for a married couple, for example, it's around $12,000 or $13,000 of standard deduction. If that's higher than mortgage interest and real estate taxes and those types of things. The proposal is to double that, make that like $25,000 or $30,000, right? Which will take a lot of people out of having to itemize. So they won't have to keep receipts. They won't have to add up their mortgage interest, real estate taxes. They're also talking about repealing the deduction for state income taxes, which that's a big one for a lot of people. But then again, if you're in alternative minimum tax, maybe not so much. But in any case, it's a simplification. So if you can get to a 30,000 plus standard deduction, you're taking a lot of people out of that itemized deduction. It really simplifies the tax form. So that's another aspect. The alternative minimum tax that I mentioned before, that's the intent is to repeal that. And it's been talked about probably every year since I've been practicing, in the last 10 years anyway, of repeal. It hasn't been repealed yet, but it looks like it may very well be repealed now. And then finally, the tax on the Affordable Care Act, the 3.8% tax on investment income, right? We'll talk about that. Maybe get to the next slide. So capital gains, right? There's one other key concept here is ordinary income, which we just went through on the tables, capital gains. So what's a capital gain? Well, capital gain is from the sale of a capital asset, right? What's a capital asset? Well, if you think about shares of stock, investments, right? Shares of stock, bonds, the ownership of your S Corp shares. If you sell your S Corporation shares, that's a capital gain. We're going to talk a little bit later about some different aspects of sales of businesses, but capital gain rates, as you can see on the chart, are, right now there's a 15% bracket. This one is a little bit different. So if you look at the current rules of the top two lines, capital gains dividends are in the orange, and essentially you've got a 15% rate, and that cutoff is up to 200, I'm sorry, that cutoff is up to 225, because after 225, you have 15% plus the 3.8% Affordable Care Act tax, that 3.8% tax on investments. Capital gains are considered investments and are subject to that tax to the extent that they exceed the 225. They plus your income exceeds 225. Okay, so that's why you see an 18.8% tax bracket in there, and that's between 225,000 and 470,000. So even with capital gains, we're managing and trying to figure out, okay, where does this gain fall in the spectrum? Is it a 15% gain? Is it an 18.8%? Or if your income from the business and your wages and everything else exceeds 470,000, now you're at a 23.8% rate. Okay, and coupled with state taxes, in Maine does not make a distinction between ordinary income and capital gains. So Maine, you're going to pay, roughly 7% now, a little bit more than that. So you're at about 30% on capital gains, 31%. So that just gives you a sense of the tax rates. And again, we're looking at tax avoidance, avoiding taxes, deferring it where we can, and we're looking at rates. What's the rate of tax, and how do we manage that in terms of planning? I guess two more points before I turn it over to Andy here is, basis. Your cost basis is going to become very important. Now, it's easy if you bought a share of Apple stock and you paid $300 for it, and now you sell it for $500. That's pretty easy. It's a $200 gain. As long as you held it for a year, it's a capital gain, long-term capital gain, and it's qualified for those lower rates. S Corp stock. Well, what's the basis? How much did you pay for it? Well, Dad gave it to me about 10 years ago. Well, what was his basis? Right? I mean, so tracking the basis is extremely important. And, if we're involved with clients who haven't, that's one of the early things we'll do is get back in there and say, look, we need to reconstruct this, because if we're going to do some planning, we need to know what the gain is when you sell your business. So that's an important concept. And I think that's about it for now. So
Okay.
I'm going to turn it over to Andy. We're going to talk about some business taxes.
Good summary, Frank, and good start. So one of the first questions I think that everyone has when they're starting up a business after they kind of come up with the business idea is, what type of business should I have? What's my legal structure? And so there's four real structures that you can consider. One is the sole proprietorship. There's a corporation, an S corporation, and a partnership. And then there's the fifth, which is the LLC, which we'll kind of talk about in the end. So everyone that's doing business is choosing one of those structures, whether they realize it or not. So if you're doing business by yourself, you don't have anyone else involved with it, by default, you're a sole proprietorship, which means that you are taking on all the liabilities of the company. You are reporting all of the income or loss from the company on your personal tax return. You don't have an obligation to file a separate tax return for the business. What you would do typically for most businesses is file what's called a Schedule C on your personal tax return. The sole proprietorship is certainly the simplest and most basic form. Obviously, there's some risk because you're not segregating your personal assets from your business assets. So, none of us are attorneys up here. There's a few attorneys in the room. So we have to be careful that we're not practicing law, but certainly liability exposure is often one of the first things that you should consider when you are operating a business. And so with a sole proprietorship, because there's no legal structure surrounded around your business, all of your personal assets could conceivably be at risk if something happens. If someone sues you for a business practice, your personal assets could be exposed under that situation. What's very similar to the sole proprietorship may be a partnership. If you're actually doing business and you have someone else that's also in business with you, and you don't have any legal structure set up, there's no operating agreement or anything like that, by default, you're actually doing business as a partnership. And there's a couple different types of partnerships. In this case, it would be considered a general partnership where both individuals are equally responsible for all liabilities. You would each be reporting your ownership percentage of the profits and losses of the entity. And you should actually file what's called a 1065, which is a partnership tax return. And that is what divides up the income and loss for your business activity. Both of those entities, certainly we don't see a lot of nowadays because most people want liability protection. So that kind of gets us into the next thing, which is a corporation. Oh, yeah. Do you want to switch to the
Page 7.
page 7? Yeah.
You're doing it, or
Sorry.
falling down on the job site?
There's two main basic types of corporations that we see. One is a C corporation, which is taxed differently than all the other business structures that we're talking about. A C corporation actually pays tax on the income of the business activity itself, and it pays them on corporate tax rates. The top corporate tax bracket right now is 35%. So as Frank just went over with that tax structure, you can see that corporations actually pay taxes at a lower rate than the top individual rate. All other types of entities actually pay tax down at the individual bracket. So 39.6 versus the 35%. What corporations also have, though, is a second layer of tax. So if you own a corporation and you want to take money out of that corporation, there are two basic ways that you can take it out. One is in the form of a salary, which reduces, obviously, the earnings at the corporate level and reduces the amount of corporate tax you're going to pay. But of course, you're going to pay tax on that personally on your salaries and wages. So that basically levels it just at your individual tax bracket. The other way is when a corporation issues a dividend, and passes money out to its shareholders based on the amount of stock they hold in such corporation. And dividends are subject to the capital gains rates. So you may be it's taxed first at the corporate level at up to 35%. And then again, as it comes out to the individual, it may be taxed anywhere from 15 up to 23.8% on that second layer of tax. So the corporate structure can be somewhat tax unfriendly for most businesses. What it does provide is it provides a great deal of liability protection. If you're a stockholder in a corporation, none of your personal assets are at risk. There's what's called the corporate veil, in that if someone sues the company, only the corporation's assets are at risk. So that's one of the popularities of a C corporation. The other factor to consider with a C corporation where we often see them is, and on the exit strategy side, if you have a company where your exit strategy might be to seek private equity or outside equity, typically those type of companies only like to invest in C corporations, and they may be interested in acquiring the stock of the C corporation. That's a good deal for the owner, because we'll talk about succession or transition planning down the road, but you can sell the stock out to an outside investor and realize a capital gain rate, which is obviously much more advantageous for the most part than an ordinary income tax rate.
One more thing on C corps, Sandy. I didn't mention this in the proposals, but one of the proposals, the Trump proposal, is to reduce that 35% corporate rate to 15%. And so I've had calls from clients, should we revoke the S election? Should we go back to a C corp because it's 15%? Well, the other part of it is, if they do reduce it, the proposals are including the pass-through entities, and they're saying if we reduce the corporate rate from 35 to 15, we're also going to reduce the rate on business income, even if it's from an S corporation, on the individual's return to the same rate. So there's talk about making it equal, so there's not this mass migration back to C corporations. Okay, I mean, and I think there's some thought that that's probably not going to go to 15. I think Congress is saying 25 might be a little bit better. I've read somewhere every 1% is about $100 million to the Treasury. So they're a little sensitive to each percentage point. But anyway, I just want to make that point. I forgot to make that point on the corporations. Yeah,
it's a good point. And one of the overriding on all the pass-through entities, whether it's an S corporation or a partnership, when you talk about that tax levelization, you're being taxed at 100% of what your ownership percentage is of that entity, not what you actually take out of the business in cash. So often I hear that from clients all the time, where how did I pay tax on $250,000? I only took out $100,000 of cash. I left all that money in the corporation. On a pass-through entity, that doesn't matter. On the C corporation, it does. Only what's left in the company is subject just to the corporate rate. You only get that second layer of tax when you actually take cash out of the company. But on a partnership or an S corporation, you're taxed on 100% of your pro rata share of the earnings of the company, whether or not you take out all of that amount in cash, or whether you take out zero of that amount in cash. So that's a really important thing. So often on a pass-through entity, when you're kind of doing this consideration, you want to make sure that you be able to issue the shareholders or the partners some cash to pay their taxes, because that tax is all going to be down at the individual level. So that's part of when you're doing your cash flow analysis and everything, you want to factor that in. The other difference, so a C, we've talked a little bit about S corps, but an S corporation is just like a C corporation, except you make what's called an S election, and that is to pass the tax down through to the individuals. So you still have that corporate level of protection that you have with a C corporation, but you don't have that second layer of taxation. The income all passes down through to the individuals. S corporations have a few restrictions to them. One, you can't have more than 100 shareholders. So, I've never had, in my years, I've never seen an S corporation where that's become a hindrance. In most small businesses here in Maine, that's not an issue, but that means like Walmart can't be an S corporation. They've got to be stuck at the C corporation. So if you're talking about being publicly traded, it's basically impossible to be an S corp. S corporations, probably the biggest thing when you're making your determination is everything has to be done pro rata. So that means if you have two people and they're 50-50 owners, and one of the owner wants to take cash out of the company, the other owner has to take the exact same amount of cash out. The income has to be allocated identically based on your ownership percentage. So there's not a lot of flexibility in terms of how you carve things up. It actually makes it pretty simple from a tax standpoint. It's probably, I would say, other than a sole proprietorship, the easiest tax structure for a practitioner to understand and to kind of get everything right. But it also does limit some flexibility. With a partnership, same thing, everything passes down through to the individual level, but partnerships, one other restriction on the S corporation is, for the most part, the owners all have to be individuals. There are some certain types of trusts, QSSTs, qualified subchapter trusts, that are allowed to be shareholders in an S corporation, but you basically have to be either an individual or a trust to own stock in an S corporation. C corporation stock can be owned by other corporations, other individuals. So there's some flexibility on that. Partnerships, anyone can be a partner in a partnership. It could be a C corporation, you could be an individual, you could be another partnership. Partnerships don't have that pro rata responsibility. So if in a partnership, if one partner wants to take cash out of the company, they can do so, and the other partner can leave their cash in the company. Everything kind of is kept score with a partnership based on what's called your capital account. Your capital account tracks basically what your investment in the partnership is. So when you initially put cash into the company, that becomes your original capital account. Your capital account is then reduced by the amount of cash you've taken out of the company, by the amount of losses that have been allocated to you, and it's increased by the amount of profits that have been allocated to you. So I like to tell clients it's kind of like your scorecard of where your investment has been through the years. A lot of times people really like that aspect of a partnership because it kind of lets them know how their investments done over time. So those are the basic four types of entities. The last one, and which is probably the most common entity that we see, is the LLC structure. LLCs can be any one of those first things that I mentioned. If you are a single member LLC, you are by default kind of a sole proprietorship, but it provides some liability protection. So most people that we see that are operating business by themselves, they form an LLC, becomes a single member LLC, which is a disregarded entity for tax purposes. It doesn't have to file a separate tax return. You simply file and report on a Schedule C. An LLC can also be taxed by default as a partnership. Sometimes you actually see an LLC that checks the box to be taxed as a corporation. So it's taxed just like a C corporation. And then they can do that and then also make an S election so that they're taxed as an S corporation. So LLCs can kind of be a little confusing in that just when you see the LLC after the name, it could be any one of those entities, and they provide just a little bit more liability protection. So you've got all those different, we kind of talked about all the different structures. When you're figuring out what structure a business owner should pick, there's no kind of magic bullet. The one thing that I think kind of everyone would first consider is if this entity is going to own real estate, you do not want to put it in a corporation. Real estate tends to appreciate in value. And so you don't want that appreciation to be stuck with a second layer of taxation that they would have for an S corporation or C corporation. And then also when you talk about actual tax basis in a partnership structure, because you are considered liable for the debts within the corporation, partnerships and LLCs kind of have a neat factor that if you have qualified non-recourse financing, so if you have debt that's secured by real estate that's an asset of the entity, that provides you tax basis to deduct losses. And so often when you're going to have a piece of real estate that's going to be subject to a mortgage, that can allow you to deduct losses that are generated for the business, even though you haven't put any cash into the business. So everyone likes that. It's other people's money, and you get an immediate benefit of a tax deduction without actually putting up your own cash for at risk, or you can take a deduction larger than what you've put in for cash into the business. So that's always a nice avenue to go. When I'm talking to clients about what structure, profitability is a really important thing in terms of everyone thinks their business is going to be immediately profitable, but particularly things that are really intensive with real estate, because of some of the depreciation rules and stuff that are in place, it may be cash flow positive, but you may generate a tax loss in the first few years for startup costs. Even operating businesses that have a lot of equipment and stuff like that in those first few years, to be able to benefit from those losses immediately, you may want to look at an LLC structure so that you can take the losses that are secured by debt that's either guaranteed by the real estate or guaranteed by you as an owner, and allow you to take those losses. With an S corporation, your basis is only what you've either put in cash or what you've personally loaned directly to the S corporation. So for an S corporation, if you went out and took a line of credit against the equipment that you're buying, and you took the depreciation on that and it generated, let's say, a $200,000 loss, and you had only put $100,000 into that company, your loss would be limited to $100,000. Whereas under the LLC structure, under that same thing, if you had a personal guarantee on that debt, you'd be able to deduct the entire $200,000. So that can be a pretty big swing. And obviously, like Frank talked about, tax deferral is one of the main things we can do. So if you can accelerate your losses and defer the income till down the road, that's a pretty good outcome for a business owner.
There's also, in terms of the entities, Andy, when you're thinking about self-employment tax, right? So, self-employment tax on a partnership, right? If you're active in the partnership and you get a K1 that has, let's say, $200,000 in it,
right?
You've got to pay self-employment tax on that if you're an active participant in that partnership. So what ends up happening is a lot of people will go to the S corporation because that same 200 coming out of an S corporation is not subject to self-employment tax. I mean, the IRS doesn't particularly like this, but it's, again, we control the facts. So if you have a choice between operating as a partnership, and again, this is not a huge amount of money, but what we're talking about are, as we talked about in our first meeting, solid singles, right? The baseball analogy. These are solid singles. You save a little bit of money here, a little bit of money here, a little bit of money here, and all of a sudden, you've got a much better cash flow. So, yes.
I have two questions. One is to your point on, S corp, paying yourself a salary. In your experience, what has the IRS position been? I understand you want to make sure it's fair market value because they're sensitive to that, right? They don't want you to avoid too many taxes.
Right. Reasonable compensation is the key word.
Reasonable compensation. Right. So, in your experience, what is their basis for reasonable compensation for an owner of an S corp, depending on the position that they hold?
So reasonable compensation is an interesting issue because you can look at it in two different ways, depending on whether you're looking at a C corporation versus an S corporation. So that's a really interesting point. Partnerships, or LLCs taxed as a partnership, in a sole proprietorship, you can't pay yourself a salary. So that's often a consideration too, because people that are starting to be a business owner for the first time. They're used to getting a W-2 that's used to how they're paying their taxes. Suddenly now you can't pay yourself a salary, so you've got to do estimated taxes, and that can be a consideration as well. If you have a corporation, whether it's a C Corp or an S Corporation, you can continue to pay yourself a salary. On the C Corporation, the IRS will often argue that you're paying yourself too high of a salary. It's unreasonable compensation because you're trying to avoid that double layer of taxation. You're trying to avoid being taxed at the corporate level, and you're pushing it all down to the individual level. So they may argue that you're paying yourself too much. With the S Corporation, they may argue that you're paying yourself not enough. So because at the S Corporation, whatever, like Frank said, whatever's taxed through to you as a flow through, you avoid the self-employment tax. And so is everyone kind of familiar with self-employment tax? Self-employment taxes is your FICA and Medicare. And if you're a self-employed person, you get to pay both sides of that. You know, everyone that's an employee, you get your 7.65 taken out of your paycheck, and you probably don't even notice. And your employer is also paying 7.65%. As well, up to the first, I guess it's 127.2 for 2017, and then once you go over that number, you pay just the Medicare, which is 2.9% or 1.45 a piece. As a self-employed person, you get to pay both sides. So often you get that from clients where they kind of they've been an employee, they start paying their business, and they're like, I don't understand how I owe so much in taxes. Well, when you tax 15.3% on top of their regular income tax bracket, it's a pretty significant jump. And so, you know, when they start doing the calculations, I'm like, they're like, wow, I have to set aside 50% of my earnings to pay taxes, and it's a pretty sobering thought process, and it's not a real fun conversation to have.
They have access. I mean, the IRS has access to studies and, you know, industry studies in terms of here's a range of compensation for this position in this company or this industry, you know, for these responsibilities. And, you know, they'll use that. I can tell you in my career, I have never had an audit on that issue.
No, and
not to say that, you know, I don't usually advise clients to take $10,000 in salary and take $1 million in distributions, but at the same time, I've never seen it really raised. They talk about it. There's a lot of writing about it. But as long as you're reasonable about the salary, the other thing I will say in a family business, if you have more than one shareholder in an S corporation, you know, you have other family members. You know, as Andy said, it's pro rata. So the income has to get spread based upon the percentage of ownership that you have in the business. So if you've done some planning and the owner only has 10%, and it's the controlling stock, and the rest of the family has 90%, he's not going to be satisfied with 10% of the earnings of the company. So he's going to want to take a bonus or something, because otherwise he's only going to get 10%.
Yeah.
So there's other factors that are going to play into it. But again, I've never seen it raised.
So on the other side of that, if you're S Corp and there's one owner in the S Corp and you have family members working in that S Corp, is the IRS sensitive to that as well? Because you can defer some taxes by pushing income over to your family members as well. So is that something the IRS keys in on?
Did everybody hear that question? The question is if you have other family members in the business, you know, does the IRS challenge payment of salaries to other family members to spread the income among the tax brackets, which is one of the strategies. You know, earlier on we talked about tax brackets, right? Well, again, you've got to document it. You've got to justify that they actually work there. They're doing something. The magnitude of the compensation is where the argument should be, not whether or not they work there, right? They should be doing something. And in family businesses, I mean, I've seen, you know, someone at 10 years old is emptying the waste baskets and doing some things around the office. You know, they're working there. So, you know,
30, yeah, I was gonna say, if you're paying them 30,000,
is it worth $50,000 a year? Probably not. I will tell you though that I've seen family businesses who have children working there right up through college. They come home in the summertime and they work there, and they might make $10,000 or $15,000 for the summer, and then they take the next step and take, you know, $5,000, put it into a Roth account, right? So $15,000, you know, under the tax structure, minimal taxes. And then the Roth is accumulating and can be used to pay college tuition without paying tax on the earnings. So there's, you know, there's ways to kind of manage that process. But I'll tell you, you got to document that they're actually doing something and that the compensation is within some reasonable range.
Yeah, it's like Frank said, it's a solid single. And what I tell my clients all the time is pigs get fat, hogs get slaughtered. So, you don't push it and don't pay them $25,000 for this, but it's a good, you don't necessarily have to pay them exactly comparable what you would pay someone off the street. Because you can kind of make that whole succession planning argument of, look, I'm starting them at the ground floor so that they really understand how this business works. But, obviously they're my own flesh and blood. I'm going to pay them a little more than I would pay a regular janitor to come in and do this stuff or whatnot. So you've got some leeway there. I think the single shareholder S Corp is probably the one that potentially can be the most at risk for unreasonable compensation, particularly if you don't have any other employees. Or really any other valued employees. I have one where I was meeting with the other day, and the individual is a commercial real estate broker. We set up an S corporation to essentially void the self-employment tax, and we look at it on an annual basis about what he should be paying himself a salary. He does all the deals, so he doesn't have anyone else. So all the income generated by that S corporation is directly from his services. So it's pretty hard to say if he's got like $1 million profit in a year and only pays himself a $50,000 salary, the IRS would probably have a big issue with that. So but if you've got a whole bunch of employees that are working for you and you can point to they're generating a lot of the revenue of the company, and you can look at what a comparable company president or CEO would be paid and range it that way. So it really kind of depends on the facts and circumstances behind it.
The IRS takes a particular interest in when they see multiple entities, because they know that you're trying to do something that you wouldn't otherwise be able to do if it was only one entity. But we've seen LLCs, operating businesses in LLCs, taxed as partnerships, as Andy said, multiple owners, and the owners will put their ownership into an S corp. So now you have the S corps are the partners in the LLC. So the LLC income would have been subject to self-employment tax had it gone directly onto the 1040. But instead, it goes through the S corporation, and the S corporation doesn't generate self-employment tax. Now, there are other business reasons for doing that, right? I mean, if you're a general partner, you might put your general partnership interest into an S corporation for legal reasons and perhaps some other reasons. You may have other business activities in that, which would definitely substantiate a non-tax avoidance purpose, which is really what the service would, that would be your defense against the challenge by the service, that you have a legitimate business purpose other than tax avoidance. Tax avoidance can be one of your purposes, but as long as there's a business purpose besides, you're on more solid ground.
And where you often see, another aspect is control, which is a really key aspect in determining what you choose. Corporations are typically governed by a board of directors, whereas partnerships, the control is really dictated by the operating agreement between the partners. So what's a very common structure is if you have, two people coming together, which is quite often where one person maybe has the expertise or the skill set, they're going to offer what's sweat equity into the partnership, and the other one's actually kind of funding and either guaranteeing the debt or putting the cash into it. The partnership structure allows you to kind of dictate how the profits and losses are going to be allocated between those two individuals. And there's some overriding rules under the Internal Revenue Code that you have to comply by, but there's a ton of flexibility. So in situations like that, the LLC structure is a pretty common, almost guarantee route to go, because with the S corporation, you can kind of make up for that a little bit with salary, but a lot of times early on, there's not the cash there to pay out in salary. So, the partner at least can, in the LLC structure, can at least take a benefit in terms of losses that will maybe offset their other income. So they get some benefit right up front before the company's cash flow positive. Gary, do you have a question?
Yeah, quick question. Along the same line in S corporations, do you use a general rule of thumb or have a recommendation on what ratio of income for an S corp owner should be salary versus S corp distribution? Obviously, 100% S corp distribution would be bad. You can have some.
Yeah, I think, I look at it again, it depends on facts and circumstances, and you look at overall what, you can pull all the money out of it. I think you can be a kind of a hands-off S corporation owner. If you've got other employees or other stockholders that are actually generating all that revenue, you can own 100% of the company and not take any salary. If you're not actually really doing any services, you're kind of a passive investor in it, and you've built the company up to the point that you can pull all the cash out that you want. That's not really an issue. But I mean, if you're there day to day and you're actually, doing all the work that's generating it, then that's a pretty hard argument to say that you shouldn't be paying yourself a much higher salary, or at least some salary.
There's information out there, Gary, that you can do, but I don't know that there's a hard and fast rule. I think it's more, what's reasonable and what's a comparable, and there's data out there. I mean, every industry typically has salary surveys, and, so you can look at whatever industry you're in and kind of zero in on a range of reasonable comp. You might go to the lower end of that range,
Right.
but, that's,
Sure.
Thanks.
Yeah.
So my second question was based on something you said, Andy, on basis versus loss. So you said something that wasn't quite clear to me on.
Sure.
Your basis is based on your investment in the corporation, and your loss is limited to your basis. So if I have depreciation, if I have a loss in 1 year that's greater than my basis, I can't take that full loss.
That loss becomes suspended, right, until you either put more cash into the company, which would free up that loss, or until the company has profits.
So that's on an S corp.
That's on an S corp. On an LLC, you can go negative,
Right.
as long as you are, as long as you have recourse debt. Recourse debt means the debt that you would be liable for in the event that the company assets didn't cover it.
So if I'm an S corp and my only investment in my corporation is, I'm a personal services company.
Yep.
I'm an S corp. I don't have any cash investment. It's just my time.
Sure.
I have employees. I have payroll. I have a loss in that year. I
You
take
can't
that
deduct it.
loss.
Correct.
well, the caveat would be if that's not your first year, if you've operated in the past at a profit,
Sure. Right.
whatever
Now
retained
I have
profit you have,
basis because
Right.
the
you can
profit is
use
each
that.
year.
Yeah.
So if I don't have basis, then I carry that loss forward
That's correct.
until I have a profitable year, and then I can offset that profit in the
Correct.
forward year. And
Correct.
then carry forward is 15 years?
That's unlimited.
It's
Unlimited for
to carry
that.
forward on that?
Yeah. I mean, the big difference is LLCs or partnerships, you can take the debt basis if it's either secured by real estate assets, or if you have a personal guarantee to it. Most banks nowadays, before they loan a company, they're going to want a personal guarantee on it. My advice to my clients is always try to avoid giving personal guarantees for anything. But I mean, a lot of times you just can't do it. So if you put a personal guarantee on it with a partnership, you can at least that gives you basis to take losses. With an S corporation, it does not. So that's a big difference. An S corp, it has to be a direct loan from you to the S corporation to put cash in, and so that's that differential.
We like personal guarantees.
Yeah, I know. It makes you warm and fuzzy, doesn't it? So I think that covers most of the big picture. I guess the overall last thing that I want to talk about with entities is if you're sitting out there going like, wow, based on everything he said, why are we an S corporation or why are we a C corporation? You're not locked in for life. You can definitely change your entity structure. Some are a lot easier to change than others. Going from a C corporation to an S corporation is as simple as filing a form and making sure that you have permissible shareholders. But there can be tax considerations by making that election. Sometimes it's a tax-free switch. Sometimes it's not. Going from a C corporation to an S corporation, the assets, which is the most common structure that you see, you're subject to what's called a built-in gains tax. So you would look at all the assets of the C corporation at the time that you make that conversion, and what the fair market value of those assets are. And if any of those assets are sold within the next 5 years after your election, you actually, the S Corp has to go back and pay tax at the C Corp rates based on what that amount is. So it's, a conversation that you obviously should have with your advisors, with your accountant before, and you kind of run those calculations about whether or not it's tax-free or not. A lot of times that can be, the tax hit could be prohibitive, but the built-in gains limit used to be a 10-year window, and now it's down to 5, so that makes it a lot easier. A lot of times if you say, yeah, we're not going to sell anything within the next 5 years, it can, let's go ahead and do it. It's not that big a risk. And then once that 5-year window goes past, you've absolved yourself of paying the built-in gains tax. The other big point when you're making the choice of entity decision is to get your whole team involved. And I think that's a theme that we have on this whole succession planning topic. Is it's not something that just your accountant should tell you, or just your attorney. Definitely you want all your professional advisors involved, because it's a pretty big decision. So, you want to take into consideration the liability exposure, and that's where the attorney's going to be involved. You obviously want to take in the tax considerations, which is where your accountant is involved. And then also, you want to be thinking down the road about where you're going, what's your exit strategy. With closely held businesses, with family-owned businesses, the exit strategy should be, even from day one, should be part of your planning consideration. So, are you going to want to give shares to your kids? Are you going to want your kids to have ownership, or your employees to have ownership, stuff like that? So it can be a lot easier if you're kind of thinking out that when you first set it up, and coming up with that structure, because the S Corp, like you said, everything has to be pro rata. So if your kids are shareholders and you want to take money out of the company, that means you got to give money to your kids too. That can be a deterrent.
Right.
Okay, so unless anyone has any more questions on the entity structure, I'll pass it over to Bill to talk about captives a little bit.
Thanks. So I just flew in from North Carolina last night, from the North Carolina Captive Insurance Association meeting, so I'm well versed in everything that's going on. I will say I was down there for the eclipse, which hit the Carolinas a little bit more directly, and there was a golf outing, and so in all of the carts they had the glasses. So it was really a non-event though. For those of us that were in the South, people made millions of dollars on this thing. It was ridiculous. But it got hazy, it got a little darker, it got cooler. Other than that, we still played golf. It was fun. And interestingly, being in North Carolina over the last year has seen an increase of their captives being domiciled in North Carolina by 91%, including some of the ones that we work with. And their segregated accounts, their cells within have increased by 50%. So North Carolina is becoming an increasingly important player in the captive insurance field. How many people are aware of captive insurance companies? How many people own a captive insurance company? All right, great. So one. So let's see how we're doing. Let me know. So captive insurance companies have been around since the 50s, but they were primarily reserved for large corporations, Boeings, GMs, etc. It wasn't until the Tax Act of 1986 that Dan mentioned that 831B, the section of the IRS code that allows for micro-captives, got formed. And there's a handout on your table if you haven't seen it. That micro-captives were approved by Congress. And they were primarily driven, interestingly, by legislators from the Midwest who were looking for agricultural support and insurance for their constituents in the Midwest. But from 1986 to 2002, it was the wild, wild west, because the IRS issued no guidance, no rulings, no safe harbors until 2002. So from 86 to 2002, it was kind of like everybody was on their own, and there was plenty of court cases, et cetera, et cetera. 2002, the IRS finally issued guidance and safe harbors on microcaptives. This is this 831B of the IRS code. And from 2002 till about 2015, 2016, things went along fairly consistently and fairly smoothly. And I'll put this into perspective until Frank mentioned earlier, things that the service finds of particular interest. So let's now fast forward, and we'll get into the mechanics of it. There's roughly 10,000 microcaptives that have been formed since 1986, but the bulk of them really from 2002 through now. Let's just take an annual premium for each of those captives at $500,000. On an annual basis, what that means to the U.S. Treasury and to state treasuries across the country is $5 billion. That's not going into the treasuries. That's instead going into reserve pools for the captive insurance industry. Multiply that by 10 years, you've got $50 billion. I think it's real money. And so when you hear, if you Google, if you hear anything about, and we'll talk about this in a couple minutes, anything about why the IRS is taking a particular interest in captive insurance companies, that could be one of the primary reasons why. So what is a captive insurance company, especially on the, and we'll talk about the 831B, the micro-captive perspective. It is basically an insurance company that you own to take care of and address risk that is not currently covered by your traditional commercial insurance policies. Deductions, exemptions, exclusions are the first three things that we look at when you're trying to identify what those risks are. But you go down the gamut in terms of what captives can cover that a commercial policy will not find either reasonably possible or reasonably available. OSHA fines, punitive damages, legislative action, supply chain interruption, loss of key customer, sexual harassment. The list is fairly broad of what your commercial policies are not currently covering or not currently covering adequately. I go back to some of the 831As from, you can remember the Jerry Sandusky deal with at Penn State. Penn State paid the bulk of their fines and their damages out of the captive insurance company that they had. They had a large captive insurance company. That's how they paid for that. So there are things that you would not customarily cover in your individual commercial policy. So you create a situation where you are going to insure risk that you currently are not insuring. It's a risk mitigation strategy, to be sure. So any of the topics, and there's more, any of the coverages that you potentially could look at could be covered through a captive insurance company. And the process we go through is we look at your current commercial, a captive manager, an underwriter, an actuarial expert, looks at your current commercial policies, looks at your recent claims history, looks at your industry, looks at your region, your geographic region, takes a pretty substantial look at what your industry is and what you're trying to insure. And they'll come back to you as a business owner and say, okay, based on your current commercial policy coverage, based on your industry, based on your region, based on your claims history, we believe that we can cover A, B, C, D, E, F, and G, and here's the corresponding premium that goes with that. So immediately you've got coverage for something that wasn't previously covered. And we can talk a little bit about that later. There are opportunities to cover areas where you've got maybe a low deductible right now and you want to increase that deductible on your commercial policy, pay a lower premium, and you can cover that through your captive as well. So there's that opportunity as well. So they'll come back to you and say, okay, here's the corresponding premium for each of those menu items. So Congress in the Tax Act and the IRS through the guidance allows businesses as a reasonable and necessary business expense to deduct those premium payments to the captive insurance companies. Up until 2017, that amount was $1.2 million. In the PATH Act at the end of 2015, Congress passed a law increasing the allowable premiums for a captive insurance company to $2.2 million, effective this year, and allows that, and then that premium is indexed to inflation. So that allowable premium is going to go up on an annual basis. So now smaller businesses have an opportunity to deduct from their net income up to $2.2 million on an annual basis to go into the captive insurance company to cover those premiums that are seen as currently commercially unavailable or reasonable. So those studies and I'll talk about what the IRS is doing now, but those studies are increasingly important to have an independent underwriter and an independent actuarial analysis done on that, because the service is coming back and saying there were bad, I think, what did you say, Andy, pigs get fat and hogs get slaughtered. There were folks that over the last 25, 30 years have tried to abuse the system. And that's really what the IRS has been cracking down on over the course of the last couple of years, is addressing folks, captive managers, promoters, underwriters, actuarial folks who have been abusing the system and really using it solely as a tax mitigation strategy. Is there a tax benefit? There's absolutely a tax benefit to the business. There's also an asset protection benefit. The assets that are held in the reserve accounts of the captive insurance company, be they, let's say, $1 million a year over 5 years, be they $5 million, be they $10 million, whatever it happens to be, those assets are protected from creditors because it's not a subsidiary corporation of the business. It's held separately and it's owned separately than the current the operating company. So we had an example, not of mine, but I know of an example where a business went bankrupt 10 years ago. Creditors were not able to get to the captive assets, and the business was then those captive assets were later dissolved and used to help the businessman restart a new business. So there's an asset protection strategy, there's an immediate income tax strategy, there's a risk mitigation strategy. Let's say walk down the road 10 years. You've been paying 10 years worth of premiums, let's say at $1 million. You've been also paying claims. One of the things that the service does not like is if the captive insurance company is not paying claims out to on any of the issues. But assume you've been paying claims, you've also been having some investment income, et cetera. Maybe you've got $8 million at the end of that 10 years that didn't go to the IRS, that you control through your captive insurance company. That money comes out to the owners of the captive insurance company at long-term cap gains, not at ordinary income. So it's never taxed at ordinary income. The only thing that's taxed at ordinary income is the interest and dividends within the captive that grow. And traditionally, captive managers, and we're an investment manager of those, as are many other financial institutions, they have a fairly conservative approach to how those assets and those reserves can be managed over the course of, certainly the first 3 years, 5 years, and then it gets a little bit more broad and diverse as you go forward.
So you can see why, from just doing the math, if you had $8 million accumulated and you got tax deductions at 40% and you pay 20% when you get it back, that's $1.6 million of tax savings over the 8 years. That's why the service doesn't like it. But it's again, and that's in the IRS code. That's
right.
why we
That's
mentioned
right.
it.
Yep. And so there's obviously there is a tax advantage to it, to the business owners. Over the last 18 months to 2 years, the service and Congress has cracked down. When they increased the allowable maximal premium to $2.2 million, they also really tried to do away with the estate planning components of captive insurance companies. Originally, when they were founded, trusts could own the captive, other family members could own the captive that weren't in the operating company. That's no longer the case. On a familial issue with direct siblings and descendants, what they want to see, especially this is relevant to family-owned businesses, they want to see the ownership in the captive mirror the ownership in the operating company. If there are non-family members that own it, they're not so concerned about that. But on the family side of it, they really want to have the captive owned on a similar standout. So what are the ideal industries for that? So manufacturing industries, transportation industries, high-risk industries, companies that have a high degree of liability. Those are the ideal industries to be covered by a captive. It's not CPA firms. You don't have that much liability. And those are really the ideal industries to be covered. And in our experience, and I've been doing this for about 4 years now, those are the companies that have been most successful. We'll have dozens, if not tens of dozens of conversations with companies across New England. I cover New England on an annual basis with companies that are interested. That funnel keeps getting smaller as we look at the industry, as we look at what their real risk is, we look at their risk profile. What's the ideal company in terms of an asset size? We're looking at a company that definitely has $1 million or more of net income, that has the capacity to deal with $500,000 a year or more in premium, that is slightly entrepreneurial, that understands that captive insurance companies, just like 401ks have been on the IRS Dirty Dozen list. They're not going away. The captive industry, the self-insurance lobby is very strong, but the service has been looking at it and trying to find ways to trim around the edges and make sure that the players that are involved, businesses, their advisors, et cetera, are really doing it for a risk mitigation strategy, and you're really operating a genuine insurance company. One of the things that's been key about this has been the issue of what is an insurance company, what must an insurance company do? It must have risk sharing and risk distribution for it to be a true and genuine insurance company. The way that's primarily done in what we've seen is that most captive managers have risk pools in which they pool all of their captive clients in a pool, and those risks are then shared. So we look at tranches. So let's say if there's a claim, first $250,000 is paid out of your own captive insurance company. The next $300,000 is paid out of the risk pool, and that is shared and distributed amongst all the other folks that are in that pool. And then there's potential for reinsurance after that, and then there's a catastrophic policy on top of that. So there's lots of different tranches, and again, as we look at what the service is doing and as we look at what the court has done, for those of you familiar, on Monday, the tax court finally had a ruling on a case called Abrahami. It was held, the court, the original hearing was in 2015, and the 105-page ruling came out from Judge Holmes on Monday. And from what we saw and what we've read about, and there's a really excellent article in Forbes yesterday about it and a couple other news organizations over the last 24 hours, what we saw was, again, people getting a little bit greedy, people trying to borrow from it, transfer money to kids. The risk pool was not set up really very well, so that risk sharing and risk distribution didn't happen. There'll be an appeals on that court case. That should be another 2 years, something along those lines. But you will see, if you Google it and if you study this and you're interested in it, you will see, additional increased scrutiny by the service in what's going on. That's not all bad. We're getting rid of bad players out of the captive manager space. We're getting out bad players in the client space. But again, Congress's act, the PATH Act at the end of 2015, increasing that allowable premium to $2.2 million. The increase, as I mentioned earlier, about in North Carolina specifically, in terms of the domicile, I think the captives are here to stay. They're not going anywhere, but there's going to be continued scrutiny by the service on them. Questions?
This is a good question. Is health insurance captive treated the same way relative to tax treatment as, like you said, business insurance captive?
Yeah, it can be. There's some stopgap captive insurance policies that have been formed and are becoming more common, and so it can be treated in much the same way. There's some additional nuances around it, but yes, it can be handled.
Thank you.
Pete?
Bill, yes, just in terms of who administers these kinds
Yep.
of entities, and also to what can one expect from a cost perspective?
Great question, and they're related, not surprisingly. So there are third-party administrators, captive management firms across the country. In our case, we've really worked pretty hard to vet about half dozen of those captive managers that we think that they do a good job. They have high-quality customer service. They're using the independent underwriters and actuaries. They have a risk pool that works, that's been audited, that's been studied, in terms of making sure that that risk sharing and that risk distribution happens. Traditionally, what I say to folks is, it's going to be about an annual fee of 50 grand to administer and run that captive. There's investment management fees, there's the captive management fees. States are doing it. Take North Carolina. Why are they becoming so good at it? Because they see it as a revenue source. So they're becoming really good at it as well. Roughly, that's about the fee. There's a capitalization requirement initially for a captive. And this has been an interesting discussion on the onshore versus offshore. Captives traditionally had been primarily offshore, the Bahamas, Cayman, St. Kitts, Nevis, Bermuda, etc. Now you take the election where those assets actually stay onshore, but they're regulated by the offshore entities. Most of those offshore entities, up until 2015, were in pretty much direct correlation with what the services was doing and what they wanted them to do. A couple of those offshore entities did not change their regulations as the IRS wanted it to, and so you've seen a lot more captives either formed onshore, North Carolina, South Carolina, Delaware, Utah, but some are still offshore. Bahamas is still pretty solid, Caymans, Bermuda, but some of the other other offshore. The reason that's important is because the capitalization requirement initially on the offshore captives was roughly $100,000, and on the onshore captives, it's all $250,000 no matter what state you're in. And the reason for that capitalization requirement is because if you have a claim, an immediate claim, you need to have those assets available for the claim, both on your own claim as well as any reinsurance claims that are and risk pooling claims that are there. But I would say on average, it's about $50,000 a year. Caveat to that, I'm gonna sound like an attorney, it depends. So there are now more and more we're seeing what they call cell captives or CELL captives. So segregated accounts of larger insurance companies. Some people call it rent-a-captive, where you're able to go in and you're able to own a piece of a larger insurance company. Your premiums then, because you're looking for a smaller piece, I've seen the lowest I've seen come down is about $300,000 on an annual premium basis. Corresponding, the management fees are lower as well, almost by half, to about $25,000 in terms of that. So we are seeing an increase in the segregated accounts and in the cell captives, but I would say absent of that, it's $25,000 on that level and then $50,000 a year. The other component of that, fees to the states, to the captive managers, to the investment managers, is, and again, this is relevant to what the service is looking at, is the amount that each individual company or captive is putting into the risk pool. And they want to be able to see that that risk pool truly is sharing and distributing that risk amongst all the companies that are in that risk pool. And so we've seen an increase in the amount of premiums going into that risk pool on an annual basis. So it's a little bit fungible. It's gone up by probably 50% over the last couple of years.
So there are obvious benefits to very large organizations to use a captive, but at what point for corporations do you see this becoming beneficial? What size corporations do you see becoming beneficial?
I see it if you have a corporation, a client yourself that's a corporation that has net income on an annual basis of, let's say, roughly $500,000 a year or more, that's about the right size. Again, on looking at those segregated accounts and those cell captives, you can go down to about $300,000 and still be comfortable in that range. Because you're initially, certainly in the initial years, you really want to look at, what percentage am I paying in my administrative fees? And, people have a hard time getting over that initial $30,000 or $50,000 on their first investment. As you go forward and add that on for a couple of years, you're going to see that better. But I would say this finally, I think that to Andy's point earlier, it's really important to have your senior management team and all of your advisors on board with this, because this isn't a short play strategy. This isn't something that you're going to do for 1 year and then say we're out. You really want to have a consistent track record, and you really want to be comfortable as a company and with your advisors that you have the wherewithal to make sure that this can be something that you can continue over the long haul. As I mentioned, there's 4 distinct reasons that it's an advantage, but you really want to see that it's something that you guys are committed to over the long haul. So one more caveat. Primarily this is done, the premiums are paid for the following year in the 4th quarter. All the premiums, if you're going to take your tax deduction, it's got to be in by December 31st, which has become my longest day of the year. As captive owners, figure out what they're going to pay and how much they're going to pay. And so the 4th quarter becomes very important because we're doing, the captive managers and the underwriters and the actuaries are doing the study. And you as business owners are finding out, okay, what can I afford next year? How did we do this year? And the service gives you some flexibility in terms of saying, okay, we had a really good year. Here are all my available risks that I'm going to cover. I'm going to cover them all to the tune of $1.5 million and life's great. Or this year wasn't so good. I really didn't have that good of a year. And I really think I could only put $500,000 into this captive. It's the same as your underwriting process on your commercial policies. If you decide you don't want to cover a specific risk or a series of specific risks and you can only afford that amount, you're allowed to do that. So it gives you a great degree of flexibility in terms of the premium that's paid. But again, this is the business owners, you own this insurance company. It's not the typical relationship you have with your insurance company and your claims adjusters where you're trying to, you make that decision. As a business owner, you decide, I have a claim, I have an issue that's come up. Do I want to take it out of my operating income or do I want to put it in as a claim to my captive insurance company? I would recommend you put it in as a claim to your captive insurance company. It keeps the service off your back. It's genuinely what it's there for. But you have that ability. Or just take a portion of it and say, I'll take a portion of it out of my operating company, a portion of it out of my captive. But it is flexible. Though you're seeing and hearing things about what the service is doing, it's not an industry that's going to go away, but it's one that all of us should be very, very aware of in terms of the changes that are evolving, the court changes, the legislative changes, but primarily it's a risk mitigation strategy.
You mentioned to Andy earlier, you're in personal services organizations that don't have much risk. Do you not recommend this as an option for personal service organizations?
It's not that I don't recommend it. It's that we've had a couple go through that underwriting, the pre-feasibility analysis, and there's just not as much there. I mean, maybe you can get $250,000 or $400,000 of risk associated with it, but again, is it a good economy of scale? I would say we haven't seen we have seen some companies do it, but I think for those industries that I mentioned earlier, those are the ones that I've seen have been very successful with it.
Frank and Andy, do you guys use that as part of your tax avoidance and tax deferral strategies for some of your?
It's a risk mitigation strategy.
Captive.
Not tax avoidance.
Well, from a tax perspective,
Insurance?
it's deferral avoidance.
We have several clients that use captives.
Yeah.
For the reasons that Bill mentioned. We don't personally as a firm, no. And I think, just to recap, it is a risk mitigation strategy. The service on the one hand has added it to the list of transactions that they're really scrutinizing. On the other hand, they've raised the limits. So they recognize that there is a place for this, and particularly for small businesses, so smaller businesses. So I think it's, as long as it's done properly and in the manner that Bill described, I think it's a legitimate strategy. And there are significant tax benefits that are sanctioned by the code.
Yeah.
So it's,
It's definitely not for everyone. I've got a couple, we've got a couple of clients that do have them. Probably 5 times as many have looked into it and gone down that process. And like Bill said, it's not a short-term play. I mean, you really need to play it out. And some of the decisions, they were like, this is great. This is too good to be true. I don't dare to do it because there's no way it can be this beneficial. Sometimes it comes down to the whole thing of like, I don't want to own an insurance company. I don't want to be a bona fide owner of an insurance company. I just want to focus on my business. And that's, you can't really fault someone for making that decision because you do need to treat it like a bona fide business that you're going to run and that you're going to pay attention to. But in the right circumstances, it's not a single, like we talked about earlier, it's a home run. It can work really well. And particularly, I see some potential as we're going into, companies are doing more and more self-insurance because they can't find the stuff out there in the marketplace, and this can be a great way to turn to that. So
Yeah, you're reducing your overall insurance costs.
right, you're paying yourself for if you're self-insuring stuff already, now you can actually pay yourself and take a tax break for doing what you're already doing in the right circumstances. So
You're choosing to retain risk,
right,
which is it goes right into the self-insurance strategy. Thank you. I think back to you, Frank.
Yeah, we've saved, the last section here to talk really about transitions. The series is on succession planning to a large extent and tax implications. And so we're going to talk for probably 20 minutes or so about just how does a business transition ownership? What are some of the factors to be considered, particularly in a family business, and talk about some of the tax considerations. So, with that, what we thought is, there's really three options for any business owner if they're thinking of exiting their business, right? And particularly in a family business, they can give away the shares. They can give away the ownership to family members by gift, right? They can sell it to family members, management, employees, or they can sell it externally. They can sell a portion or all of the company to another competitor. They can bring in private equity capital. They can, bring in another investor and as a stage, for ultimately exiting the business. So, those are really the universe of options. And so we're going to walk down through each one of them and talk just a little bit about what the tax implications are of each one and maybe some of the techniques that we've seen and examples that we've seen in business. Let's talk about gifts just for a minute. So, that's pretty straightforward, right? You make a transfer of ownership, whether it's 5%, 10%, or more, to a family member. What are the tax consequences? Well, if it's less than $5.5 million in value, there's no tax consequence. There's no gift tax. The recipient doesn't pay tax on it. You've essentially just given up ownership in the business and transferred it to someone else. From a tax perspective, that person who receives the ownership takes your basis, your cost basis in that ownership interest. So there's no tax currently, but that person, when they sell the ownership interest, is going to pay on a gain measured by your tax basis. So you've deferred the income tax consequences on that particular transaction. They also pick up your holding period. Remember I said for capital gain, you have to have owned it for at least a year. So in this case, if you give away a share of stock, that person receiving that share of stock takes your basis and your holding period. So if you've held it for 10 years, they've considered to have held it for 10 years. They could sell it the next day and have a long-term capital gain. Okay, so those are some of the in terms of a gift tax. Let's see. So go ahead.
Yeah, well, sometimes you'll see these in conjunction. So we're going to talk about the sales before, but often an owner that may know that he's going to sell but wants to kind of share some of that wealth with a family member may gift his shares shortly before kind of going to market with selling the company, so that rather than they paying the entire amount of tax liability and then distributing out cash after, they kind of pass that on. And where I've seen that work really well is I had a business owner that lived in Maine. It was a Maine business, but he had kids that one of them lived in Washington State, one of them lived in Florida. So by transferring the shares beforehand, everything that he transferred to them avoided at least the Maine state income tax. If he had paid it all up front, he would have paid full Maine freight on that capital gain. He just passed it off down to the kids where they avoided the state income tax. And at the time it saved 8.5%, which it was around a $10 million gain. So, not all of that went to the kids, but it made way more sense to gift before selling.
Right. And the other thing about that, I talked about value as long as it's less than $5.5 million. Well, what's the value of those shares, right? Well, if you've got a minority interest, if you're giving away a 5% interest in the business, there are valuation discounts that can be taken in terms of that gift. So let's say I'm going to sell the company probably next year. I've got a buyer, but it's going to happen a little ways out. And I want to spread some money around the family. And so I'm going to make a gift of 5%, 10%. I go out and obtain a valuation, and I get a discounted value of those shares. If the business is worth $10 million and I'm giving away 10%, it's nominally $1 million. However, that person doesn't have any control over the company. They can't compel distributions. They can't raise their salary. They can't raise the dividend. So there's a lot of limitations on what that stock can do, which is reflected in a discount to that value. Could be as much as 30 or 40%. So you're transferring that value, right, that you would have paid tax on. Transfer it at, let's say, $700,000, right? And a year and a half later, the company is sold, and that person receives $1 million, right? From an estate tax purpose, you've already taken $300,000 out of your estate, in my example, and you've transferred, a capital gain of $300,000, of actually something greater than that probably, because your basis isn't 700, it's probably lower than that. So you've transferred that income tax consequence to the other shareholders. So another reason, to be able to use discounts as long as you have enough time between the sale. Because again, as you can imagine, if you did it today and the company sold on Thanksgiving, well, the service has the benefit of hindsight, and it's too close, and it was probably in discussions right now anyway. So as long as you're negotiating, or if you have some kind of letter of intent or any kind of other evidence of conversations with respect to a sale, you're probably limited in terms of being able to use that discount. So,
Jennifer.
I just add to that, if you don't mind, that
Yeah.
if a client or if any family business owner is thinking about that transition, to also consider if you're charitably inclined to make that gift to a charitable organization before as well, because there will be incredible tax benefits for that, and then they can front load their charitable gifts, get their deduction then, and make those gifts over time.
Does the Maine Community Foundation accept gifts of privately held stock?
Yes.
Okay, great. So does everybody understand that? I'm going to sell my company, and I decide I want to benefit a charity. So I can take 10% of my stock, donate it. So not only do I avoid the tax, but I get a current charitable deduction for the value of those shares. So that $700,000 in my example would be a tax deduction that I would get. Plus, I won't pay tax on 10% of the proceeds. So thanks, Jennifer. That's, we didn't talk about charity other than my client who didn't want to pay any estate tax earlier, but good point.
Well, it goes into trusts as well, putting in a charitable remainder unit trust or
Right,
annuity
yep.
trust, and having that same benefit.
Yep.
And that's the point of being able to make the gifts over time. You don't have to know what organization you want to have it now, but you can get the charitable deduction up front.
Yep. And Bill mentioned trusts. That's another aspect of it. There are what's called grantor retained annuity trusts, GRATs, in our parlance. And essentially what that is you transfer your shares of stock to a trust, typically for the benefit of your children. It's, let's say, a 2 or 3 year trust. And basically you have to take a return from that trust. And it works very well with an S corporation, because the S corporation is usually making tax distributions. So I transfer 10% to this grantor trust. It's a gift, but it's a gift measured by the difference between the value of the shares and the value of the income stream that I've retained over the next 2 or 3 years. So a lot of people will zero that out. They'll basically say, well, I'll make the income stream equal to the value of the shares, so there's no gift tax consequences. And then as the company operates, there's a distribution to the trust for taxes, which is paid to me as the grantor of the trust. I pay the tax on it, and then after 3 years, that stock goes to the children. I'm not using any gift tax exclusion. And again, I mean, we're jumping into the estate tax realm a little bit, but everyone has that $5.5 million that they can use to gift during lifetime or at death. I'm not using any of that by using this strategy. And I've seen it done. We had a client who executed this about 2 years ahead of a sale, The company was very profitable. There were a lot of cash distributions. So there were distributions being made in excess of the need for taxes. So that cash went to the owners, and actually the trusts began to accumulate some cash as well. So it was a very effective transaction. When the company was ultimately sold, so the trusts got quite a bit of cash, and it was a success all around from an estate and an income tax.
And we talked a little bit about the tax changes for the income tax levels, but there's estate tax is also one of those things that's up in the air that we're talking about completely changing the way that whole thing is structured. Maybe even to the elimination of an estate tax, which the big thing right now is that there is an estate tax limitation, but when you inherit something at date of death, you get a step up in your basis. So essentially the former owner or their estate pays the taxes on appreciation or fair market value, but then the decedents, or the beneficiaries, I should say, kind of take everything after tax. They've got the stepped up value, and they can kind of, if they immediately liquidate it, they have no tax implication. If we switch to, or at least the proposed structures of switching to a no estate taxes, you also will get a carryover basis. So you're actually passing down that capital gain on to the next generation, which is a big structure, and that can change a lot of the tax planning considerations as well.
So let's suppose you don't want to give the stock away. Suppose you need the money, right? I mean, you don't want to give it to the kids. You want to sell it to them, or you want to provide, that I want the value for this company, and I'll give them a little bit of a break, but I don't want to really give it to them. So how do you do that? Well, you have a couple options there. You can redeem your shares, right, from the company. There's really two ways to get your money out. And by the way, one of the things that I tell clients right up front is, in a transaction for a business, the business always buys itself, okay? The business always pays for itself. So if you think about it, an independent buyer comes in, pays you cash for the business, they borrow the money from the bank. Where do they get the money to pay the bank back? From the business. You sell the stock, you sell the business to your kids or a management team. They typically don't have enough money to pay you 100%, so where do they get the money? They get the money from the business. So there's really two ways to structure the buyout of let's call it the first generation shareholder, right? One is to redeem their shares. So that's where the corporation buys the stock back. Now, in that case, you want to have another shareholder, because as you buy your stock back, that other shareholder's ownership will go up. So what we've seen, and we've done this in a couple of family situations, father-son type situations. We've had the son take some stock. Now, it could be sold to him for a nominal amount, it could be 5%. It could be compensated to him. It could give them 5% of the company as a bonus. And the company gets a tax deduction then for the stock that goes to the second generation owner. And then you enter into a buy-sell agreement to protect against, the untimely death of the first generation. So if something happens, the son collects the insurance money, pays it to the estate. Now he owns 100% of the company, and the estate has the cash to distribute amongst the other siblings or the other beneficiaries of the estate. But in terms of the redemption plan, as long as you have the son in for, let's say, 5%, now you can begin to redeem the owner. And an S corporation is a particularly good vehicle for doing that, because as we said before, if you leave money in the S corporation, right, the S corporation, the sort of the undistributed profits, right? The money, if the company earns $500,000 but only distributes $200 to pay taxes, the $300 is left in the business. That accumulates and provides tax basis. So properly structured, the first generation owner can tap into that basis and use that to take that money first. So we can really defer the tax consequences to later on as you redeem the shareholder over a period of time. So the redemption, particularly in a family situation with an S corporation, there's some very, very creative ways that you can do that and defer the income tax consequences to the first generation. So we've done that in a couple of cases, and that's sort of ongoing. The other technique I think that's appropriate in these situations is, let's say, the first generation owner was the founder of the business. right, in a combination of a redemption and, let's say, a deferred compensation arrangement, you could agree with the departing owner that, you know, in recognition of his contribution in founding the business and driving the value of the business over the last, you know, how many years, we're going to pay a deferred compensation benefit, say $100,000 a year for 10 years, right? Well, that becomes an obligation of the company. The company, when it actually pays that every year for 10 years, gets a tax deduction. The owner picks it up as ordinary income, and this is where the rub is a little bit, right? So if he were to sell the stock, it's a capital gain. But if he takes $100,000 in deferred compensation and takes the rest for the stock, that deferred compensation piece is ordinary income. So it goes through the tax brackets that we talked about before as ordinary income. So it may be a greater cost. However, from the family's perspective, the business is getting a tax deduction for the 100. So the son, the second generation owner, picks up a deduction. The father, the first generation, picks up ordinary income. From a family perspective, we're tax neutral. Okay, so what we'll probably do in that situation is we'll probably revise the pricing a little bit. So first generation owner gets a little bit more, maybe closer to what he would get on an after tax for a deferred for a capital gain sale. And the son would pay a little bit more, and he's okay with that because you get a tax deduction. So I think it works out to a tax savings for the family, and properly structured, it provides some security for the departing owner as well. He's got some compensation that's locked in, and obviously with a father-son or a first-gen, second-gen sale, it's not like the bank is going to be calling every quarter if you don't make the payments. You know, dad realizes there's some ups and downs in the business, then, you know, he may not take a payment that quarter. But in any case, you know, combining that deferred compensation benefit with a buyout can be very effective from a tax perspective.
Yeah, and in retirement, you know, first generation may be in a lower tax bracket too, so that ordinary, taking it as ordinary income may not be as severe of a penalty as they thought. And so that whole stock versus selling assets and potentially recognizing ordinary income is often part of the negotiation process of looking at, you know, what the best way to structure it is. In a family business, it can be pretty easy because you assume everything's going to be friendly. I've been involved with family transactions that aren't, and that can, you know, even in a family transaction, you want to look at it, I think, from an arm's length perspective, because often, you know, the terms kind of change as you go. It quite often is first generation kind of decides what they need to live off from, and they determine the selling price based on that. And that can just lead to some problems down the road, particularly if their lifestyle kind of changes and they need more and more, and then suddenly they keep coming back and looking for an additional amount. And often the next generation wants kind of a clear cutoff. So those are things that you need to consider as well. Pete, did you have a question?
I just had a question, Frank. How does the deferred comp strategy differ from, let's say, an installment sale, where they're giving them a portion, you know, each year from a tax perspective?
Well, the installment sale, Pete, is not deductible. The payments from the installment sale are not deductible.
Yes,
So you know, right. So you're getting the tax deduction that you're not getting for the other payments. Yeah.
And presumably the one big warning I throw out for all installment sales is if you have a portion of the sale, if you're doing an installment sale and it's an asset sale of the company, and part of that sale is going to be ordinary income recapture. So if you're selling depreciable assets, that entire amount is due in year one of the sale, even if there's no cash that goes out. So it's just an important thing to consider.
Yeah. Well, I'll reiterate something that Andy said before too, especially in these succession planning discussions, right? There's the financial planning for first generation, right? What do they need? And you may have covered this in the first session. Unfortunately, I was on vacation, but they, you know, what does the departing generation need? What are their cash needs? So that's a very important first step. That's a financial planning exercise, should be done with a financial planner. There are legal documents, you know, the risk protection of the company. You know, what if something happens to the owner? What's the payment structure? What's the valuation methodology? Is the life insurance included in the value? You know, that's a big one. I've seen that. That's been the subject of a lot of controversy where the owner dies, the company collects several $1 million of life insurance, and now there's a dispute because the life insurance is being added to the value of the company. Well, that wasn't the intent. The intent was for it to be a funding mechanism, not to add value so that you're paying for the life insurance proceeds. I mean, but it needs to be spelled out. It needs to be spelled out because it's going to be the subject of, you know, prolonged litigation, and I've seen it. So, you know, so there's legal, there's financial planning, there's the tax, there's insurance. You know, there's a lot that goes into it. So in terms of formulating the entire plan, you really need to have all those bases covered. And you may have a relationship with one or of those types of people, but I would encourage you, if you're going through this process, have them consult with people in the various disciplines just to make sure you're covering all the bases. It's a pretty significant transaction. The one last thing I'll say, and you've probably seen it in Maine, is the ESOP craze that we're going through right now, right? There's an awful lot of companies that have decided to sell to their employees. And it's a very, very tax-effective strategy. If you're using a C Corp, as Andy mentioned, you can even defer the tax on the proceeds, right? If you sell your C Corp shares to an ESOP, you can park the proceeds in a portfolio of securities and not pay tax until you sell those securities. I mean, that's a huge tax benefit for the seller. But on the other hand, if the ESOP owns 100% of an S corporation, there's no tax. So as an owner, if you sell your business to your employees, and without getting into the details of the structure, let's say you get a 10% down payment and you're taking 90% in deferred payments, okay? The risk of repayment goes down substantially when you know that the company doesn't have to pay income taxes now, right? So if the company's making $500 to $1 million a year in profits and doesn't have to pay income tax, there's a lot less risk of you getting paid as the selling owner to the ESOP. Plus, in what we're seeing, and you've probably seen, Maine Biz has covered this, probably every issue there's a new ESOP company. You know, you see owners who are selling their business, but they're staying on. They're staying on for 5 years, 6 years, 10 years. I mean, there's probably two reasons. One, they want to make sure the company sustains itself so they get paid. That's probably the first reason. The second reason is there's a legacy there. These people want to see that company succeed. They want to develop the management team. They want to make sure when they actually do leave in 6, 7, 10 years that there's enough management depth to run the company. So I wanted to put that out there. It's another option, and you know, it can be very effective in the right situation.
Yeah, you can also do a partial sale to an ESOP too. So you don't have to sell 100% of the company to the ESOP. So that can work out as well too.
So thank you. We have about 3 more minutes, and I really would appreciate your guys' feedback for our survey. So thank you all very much.
Thank you. Thanks for coming.
I will go around too. We do have some door prizes, so you can talk to
You're right. No problem filling the time.
I know, it's like, oh, I'm already way over. I'm going to go to Bill. Like, forget that other stuff.
Were we debating whether or not we would?
Yeah.
Yeah, I know. I was wondering. Maybe we could do it.
So micro captive that I have, that they sent their financial stuff up last week. And I get the financial statements, and total premiums are 1.22 million. Like, guys, this is a problem. I thought it went up to 2.2. Yeah, in 2017. This is 2016 tax year. Whoops. Why did